When we first meet with prospective clients, one question we ask is, what keeps you up at night? In the next 10 minutes, we're going to review a number of common concerns that we think will help you and your family prepare for a worry-free retirement. The best retirement plan starts with your expenses. The better job you do in keeping track of your expenses, the easier it is to plan, not only for your living income, but also for your taxes and your investment strategy. Remember to allow for expenses that come with advanced age. There are a lot of things that you do for yourself now that eventually you're going to need assistance in doing. And also keep a close eye on your discretionary spending. Every $5 of spending per week above what your guaranteed income support requires $10,000 in savings. Our first worry-free retirement tip is to follow a budget and to use guaranteed income sources to match your basic expenses. Doing this removes investment risk from your basic business services, meaning that even if the investment climate changes and we enter into a prolonged period of poor returns, you'll still be able to maintain your basic standard of living. And don't forget, retirement lasts a long time. The current life expectancy for a 65-year-old is just under 20 years and increasing. Inflation might be low now, but it's not forgotten. Last year, the inflation average was 1.07%, but the 20-year inflation average is 3.72%. Remember, the average retiree is going to live about 20 years, so that means that for every $100 you spend today, it will take $155 to purchase the same amount of goods towards the end of your retirement. To help protect yourself, you need to invest enough in inflation hedging assets to allow your income to keep pace with inflation. Be proactive with your health. Typically, medical expenses are the single biggest item in a retiree's budget. Taking good care of your health now can really help keep your expenses in check. So exercise at least 20 minutes a day, reduce your sugar intake, watch your weight, and have annual checkups. Healthcare cost is the biggest item in your retirement budget, and your health insurance premium makes up a big part of that. The average retiree spends about $5,000 a year on their health costs. Medicare Part B goes up according to your tax bracket. The range in cost for Medicare Part B is anywhere from $146 to $335 a month. In addition to that, most people purchase supplemental or prescription drug benefits in addition to having Medicare's Part A and B. Don't forget, the tax rates on individuals are higher than they are for couples, so that if you become a widow, your tax rate is quite likely to go up, which would also increase the cost of your Medicare Part B program. We also suggest that you have your deductible and co-payments in either a health savings account or in cash reserves. As we age, we're going to need additional help for items that are not necessarily medically related, but are age related. For example, you might need someone to come in and help you get in and out of bed, or to do the grocery shopping for you, or clean the house. You might need help preparing your meals and grocery shopping. There are essentially 4 different strategies you can use to help plan for and budget for these expenses. The first option would be to self-pay. The second option would be to purchase traditional long-term care insurance, or you could purchase a hybrid insurance policy. Many of the current life insurance and annuity contracts offer very low-cost riders that make a pool of money available to help cover these expenses in your advanced age. The next resort would be for your family to help cover these costs, and a last resort would be a reverse mortgage if you own a home. Taxes are another area of significant expense during retirement. Take steps now to reduce your long-term tax bite. One area to pay particular attention to is the required minimum distribution, or RMD tax. The RMD is a way for the IRS to force you to take money out of your traditional IRA and 401k plans based on your age. Oftentimes, the amount that the government requires you to take out is in excess of what you require for your spending. And since you're required to pay taxes on that excess, I've seen situations where the RMD has put people into a higher tax bracket, not only resulting in paying more taxes, but it can also increase the Medicare Part B premium. The other tax that many retirees are not aware of is what we call the widow tax. When your spouse dies, in addition to losing your spouse, you also lose a lot of tax deductions. In addition, tax rates for singles are higher than they are for couples. So when someone loses their spouse, even if they reduce their expenses, oftentimes they're still going to be in a higher marginal tax bracket. So beware the RMD and beware the widow tax. Have an exit strategy on all investments. There have been 10 corrections of 10% or more in the last 20 years in the U.S. stock market. Volatility is a nemesis of all retirement investment plans. So protect your resources from loss, know how much you're willing to risk, and make sure that you set guidelines within your investments to protect your resources. Also, both spouses should be informed of investment decisions. We don't know which one of us is going to pass on first, and you want the other spouse to be educated, even if they're not interested. They need to know what's going on so that they can take over in the event one spouse becomes incapacitated or dies. Teach your children about money. There's a saying in the financial services industry about baby boomers being the middle of a financial sandwich. A financial sandwich is made up of 2 slices of bread and some meat in the middle. The top slice represents your parents, who are living longer than many expected and may not have the resources set aside to support themselves during the prolonged retirement number of years. The bottom slice are your adult children that never really learned how to budget and how to live within their means. These are the people that frequently ask for loans but never have the means to be able to actually repay those loans. And the meat in the middle are the high age earning folks who are trying to save for their own retirement while supporting both their parents and their adult children. You don't want to be any part of this family dynamic, so try to avoid being part of a financial sandwich. Our last worry-free retirement tip is to contact us for a second opinion of your retirement strategy. Our no-cost meeting allows you to discuss what your retirement objectives are, review the expenses and the track record of your investments, review your long-term tax implications, and potential hidden healthcare liabilities. Finally, we score your retirement plan in terms of likelihood of meeting your stated objectives. We do this at no cost, and we use independent analytics in all of our research. Contact us to schedule your free consultation today.